Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Islamic business finance. Islamic business finance is a rapidly growing field that offers a unique approach to banking and investing, catering to the needs of the global Muslim population. Adhering to Sharia law, it prohibits interest-based transactions and focuses on ethical, risk-sharing practices. This guide will provide an overview of the fundamental principles and key products within Islamic business finance, as well as its differentiation from conventional banking. The basis for Islamic finance is rooted in the belief that money itself has no intrinsic value, and it must only be generated through trade and investment. This core belief leads to the prohibition of interest, known as Riba, ensuring that financial transactions are free from exploitation. By following the key principles of Islamic finance, such as the avoidance of prohibited business activities, you can be confident that your financial endeavors will align with ethical and responsible practices. Islamic business finance is a diverse and complex topic that encompasses various aspects of Islamic law, finance, and investment. Throughout this guide, you will explore these dimensions in detail, gain a better understanding of what sets Islamic finance apart from conventional banking, and discover the potential for Sharia-compliant investment opportunities. Islamic business finance, basic principles. Sharia compliance. In Islamic business finance, it is crucial to ensure that all financial transactions and business activities adhere to Sharia law. This legal framework governs the moral and ethical aspects of financial dealings and business practices for Muslims. By following these principles, you can maintain a successful and compliant business operation. Riba, the concept of interest. A key principle in Islamic finance is the prohibition of interest, riba. Charging or earning interest is considered exploitative and unjust, as it unfairly benefits the lender at the expense of the borrower. To avoid the concept of riba, Islamic financing uses alternative methods, such as profit-sharing or trade-based financing agreements. This ensures that the financial benefits are distributed fairly between all parties involved. Ethical investment practices. Another important aspect of Islamic business finance is the focus on ethical investment practices. Investments must be made in legitimate trade and asset-based ventures. Also, the use of money for the sole purpose of making money is expressly forbidden. These investments should provide social and ethical benefits to society beyond just generating profit. Hence, Islamic finance restricts investments in prohibited activities, such as arms manufacturing or alcohol production, to ensure compliance with moral principles. By adhering to these basic principles, you can successfully navigate the world of Islamic business finance and uphold Sharia-compliant practices in your business endeavors. Remember to prioritize Sharia compliance, steer clear of riba, and champion ethical investment practices to build a prosperous and responsible business within the guidelines of Islamic finance. Key Islamic finance products. Murabaha. Murabaha is a widely used Islamic finance product that involves a cost-plus-profit transaction. In this arrangement, the financier purchases an asset on behalf of the client and then sells it to the client at a predetermined profit margin. The client usually makes deferred payments in installments. This structure is often employed in various trade and asset financing scenarios. As a user of Murabaha financing, you should be aware that this product adheres to the principles of Sharia law, which prohibits interest-based transactions. Sukuk. Sukuk, often referred to as Islamic bonds, are a popular Islamic finance product designed to generate capital while complying with Sharia principles. Unlike conventional bonds, Sukuk represent partial ownership in an underlying asset and provide returns through profit sharing or rental income. They are often used for raising capital for infrastructure projects or refinancing existing debt, enabling investors to diversify their portfolios while staying Sharia compliant. Ijara. Ijara is an Islamic leasing agreement, in which one party leases an asset to another for a specific period and agreed upon rental payments. This product enables you to use an asset without acquiring full ownership while still enjoying the benefits it provides. Ijara can be structured in various ways, including sale and leaseback or lease with an option to purchase, Ijara wa Iktina, which gives you the alternative to acquire the asset at the end of the lease term. Mudaraba. Mudaraba is an investment partnership between an investor, known as the Rabu-el-Mal, and an entrepreneur or fund manager, known as the Mudarib. In this arrangement, the investor provides capital while the Mudarib manages the investment and offers their expertise and services. Profits are shared according to an agreed-upon ratio, reflecting the collaboration spirit of shared risk and reward. However, if the venture incurs a loss, the investor bears the financial loss, while the Mudarib loses their time and effort. As a participant in a Mudaraba partnership, you can benefit from this profit-sharing model while staying in line with Sharia principles. Islamic banking and conventional banking. Key differences. In order to understand Islamic business finance, it's important to recognize the key differences between Islamic banking and conventional banking. One of the central distinctions is that Islamic banking adheres to Sharia law, whereas conventional banking does not. This means that certain financial practices, such as collecting and paying interest, are prohibited. As such, Islamic banking transactions are asset-backed, ensuring that a tangible asset is involved in each transaction, unlike conventional banking where loans may be unsecured. Interest, Riba. In Islamic banking, interest is considered Riba and is strictly forbidden. Conventional banks, however, rely on interest as a key component of their revenue. Uncertainty, Ijara. Transactions in Islamic banking must be transparent, free from uncertainty and speculation. This contrasts with conventional banking, where derivatives and other complex financial products are commonly traded. Ethical investments, Islamic banks can only invest in businesses that align with Sharia law, avoiding sectors such as alcohol, gambling, or weaponry. Conventional banks do not have such restrictions. Convergence and challenges. As the Islamic finance industry continues to grow, it faces the challenge of integrating with conventional banking systems. Many financial institutions are now offering both conventional and Islamic products in order to cater to a broader customer base. Despite these efforts, there are still barriers between Islamic and conventional banking systems. Regulatory framework. As Islamic banking adheres to a different set of principles, it requires a distinct regulatory framework. This can create discrepancies in regulations, impacting the ability to provide a seamless experience to customers. Liquidity management. Since Islamic banks are prohibited from participating in interest-based transactions, they face challenges in managing their short-term liquidity. Financial innovation. Conventional banks have greater flexibility to develop new financial products and services, while Islamic banks must ensure that their innovations comply with Sharia principles. Overall, as you navigate the world of Islamic business finance, understanding the differences between Islamic and conventional banking is essential. As the industry evolves, opportunities for collaboration and growth between these two systems will continue to emerge and facilitate the needs of diverse customers. Prohibited business activities in Islamic law. Islamic finance is governed by the principles of Sharia law, which outlines various restrictions on permissible business activities. In this section, we will discuss the prohibited business activities in Islamic law, focusing on trade in haram goods and engagement in unethical activities. Trade in haram goods. In Islamic finance, it is forbidden to engage in transactions or trades involving haram goods, which are products and services deemed unlawful under Sharia law. Some examples of haram goods include alcohol. The production, sale, and consumption of alcoholic beverages are prohibited. Gambling. All forms of gambling are considered haram and must be avoided. Pork. Trading in pork and pork-related products is not allowed, as pigs are considered impure in Islam. Pornography. Producing, distributing, or investing in pornography is strictly forbidden. As a participant in Islamic finance, you must ensure that your business activities are free from any involvement in these haram goods. This is to uphold the principles of Sharia law and ensure fairness and justice in all transactions. Engagement in unethical activities. Beyond trading in haram goods, Islamic law also prohibits engagement in unethical practices. These activities are considered harmful or exploitative and must be avoided to ensure ethical and fair business transactions. Some examples of unethical activities include Usury, riba charging or paying interest is strictly forbidden in Islamic finance, as it is considered unjust and exploitative. Speculation, gara participating in high-risk, speculative transactions based on uncertainty is not allowed, as it may lead to unfair outcomes or losses for one of the parties involved. Insider trading, trading based on non-public, privileged information is considered unethical and unjust, and must be avoided. Fraud and deception, engaging in activities that involve deceit, dishonesty, or manipulation in business transactions is strictly prohibited. It is crucial for you to adhere to these guidelines when conducting business activities in compliance with Islamic law. By avoiding haram goods and unethical practices, you can uphold the principles of Sharia law, ensuring fairness, justice, and ethical conduct in your financial transactions. Global landscape of Islamic finance. Market trends. In recent years, the Islamic finance industry has shown remarkable growth and resilience, driven by increasing demand for Sharia-compliant products and services. Several key market trends have emerged, influencing its global landscape. The Sukuk market, an important part of Islamic finance, has strengthened, with issuances increasing to fund infrastructure projects and support economic growth. Additionally, Islamic banks are focusing on becoming more streamlined and efficient through digitalization and adopting financial technology, fintech, solutions. Islamic finance in key geographies. Islamic finance has witnessed significant development in key geographies, with countries like Bahrain, Saudi Arabia, the United Arab Emirates, and Malaysia leading the way. Bahrain, as a pioneer in the Islamic banking sector, Bahrain has been at the forefront of developing a robust regulatory framework for Sharia-compliant financial institutions. The country is home to numerous leading Islamic banks, and has promoted innovation through the establishment of a fintech hub. Saudi Arabia, the kingdom has taken considerable steps to develop its Islamic finance industry, with a comprehensive set of regulations and policies in place. Saudi Arabia boasts a large domestic market for Islamic financial products and has witnessed significant growth in the Sukuk market. United Arab Emirates, the UAE offers an attractive environment for Islamic finance, with Dubai positioning itself as the global hub. The country has a wide range of Sharia-compliant financial institutions, and has been actively promoting the growth of the industry through numerous initiatives. Malaysia, as a major player in the global Islamic finance landscape, Malaysia has a sophisticated regulatory framework and an innovative market for Islamic financial products. The country is well known for its Sukuk issuances and offers a diverse range of products and services in the sector. By understanding the market trends and regional developments, you can gain valuable insights into how Islamic finance is shaping the global financial landscape. By embracing emerging opportunities and adapting to the dynamic environment, Islamic finance holds vast potential for further growth and expansion. Sharia-compliant investment opportunities. In the world of Islamic business finance, you have various investment opportunities that adhere to Sharia principles. This guide will discuss three main types of Sharia-compliant investment opportunities: equity investments, debt capital market instruments, and asset-backed securities. Equity investments. Equity investments are a common method for ensuring your investments are aligned with Sharia principles. These investments involve purchasing shares of companies that operate in a Sharia-compliant manner. This means they avoid sectors such as alcohol, tobacco, gambling, adult entertainment, conventional financial services. When assessing potential investments, it is crucial to review a company's financial ratios to ensure compliance. To adhere to Sharia law, a company's debt-to-equity ratio should be below 1/3, and the amount of interest earnings should also be limited. Moreover, one can consider investing in Islamic funds that pool financial resources from multiple investors to invest in Sharia-compliant companies and sectors. These provide a diversified and professionally managed investment portfolio, aligning your finances with your values. Debt capital market instruments. Debt capital market instruments, such as Sukuk, are another Sharia-compliant investment opportunity. Sukuk are the Islamic equivalent of bonds, but they differ from conventional bonds in a significant way. Instead of paying interest, Sukuk holders receive a share of the underlying asset's revenue, ensuring compliance with the prohibition of interest, Riba, in Sharia law. As an investor in Sukuk, you will have an ownership interest in the underlying assets rather than just receiving interest payments. This type of investment adheres to the principles of risk and profit sharing, making it an attractive option for those seeking sustainable and ethical investments. Asset-backed securities. The final Sharia-compliant investment opportunity is asset-backed securities. This investment follows the principle that transactions must involve real assets, such as real estate, commodities, or leasing contracts. These investments can take the form of trade finance or asset leasing, allowing you to invest in various tangible assets that generate income compliant with Sharia law. One example of asset-backed securities is the Sharia-compliant Real Estate Investment Trust, REIT. A REIT allows you to invest in a diversified portfolio of property assets, providing regular rental income and potential capital appreciation. In summary, there are various Sharia-compliant investment opportunities available for you to consider. By investing in equity investments, debt capital market instruments and asset-backed securities, you can align your financial decisions with your ethical and religious values, ensuring a sustainable and responsible investment strategy. Future perspectives and challenges. Innovation in Islamic finance. As you are aware, the Islamic finance industry is constantly evolving. This growth is driven by recent and prospective developments in financial inclusion, support for small and medium-sized enterprises, and investment in public infrastructure. This section will focus on the trends and innovation in the Islamic finance sector, and the challenges it may face. One of the key trends in Islamic finance is the inclusion of environmental, social, and governance (ESG) factors. Considering these factors has led to increased demand in the industry. This implies that you might expect more sustainable and responsible investment options to emerge within Islamic finance. Another promising area is financial technology, fintech. As a stakeholder in the Islamic finance industry, you will likely witness the rise of digital platforms and innovative solutions in the coming years. This can include products such as mobile banking apps tailored to Sharia-compliant finance, robo-advisors, and blockchain-based sukuks. Regulatory and ethical challenges. Despite the growth and innovation, there will inevitably be challenges that you should be prepared for. One of the major concerns for regulators and stakeholders like yourself in the Islamic finance industry is the lack of harmonization. This can be caused by differing interpretations of Sharia principles, which might affect product development and standardization across various jurisdictions. In addition, as the industry expands, ethical challenges may arise. It's essential to maintain the ethical principles that underpin Islamic finance. This means providing transparent and equitable financial products and services, while avoiding excessive risk-taking and speculative behavior. Upholding these principles will ensure that the industry remains true to its roots and can continue to grow in a sustainable way. As you navigate the future of Islamic business finance, you should remain vigilant in understanding and addressing the challenges while embracing the potential for innovation that lies ahead. By doing so, you'll contribute to the continued success and advancement of the industry. How do Islamic loans differ from conventional loans? Islamic loans are based on Sharia principles, which means they do not involve interest, riba, like conventional loans. Instead, Islamic finance transactions often involve a sharing of risk and profit between the lender and borrower. This helps ensure that both parties have a vested interest in the success of the business or investment being financed. What is the commodity Murabaha structure? The commodity Murabaha structure is a common method used in Islamic finance transactions. It involves the purchase and sale of a commodity, where the financier buys the commodity at a specific price and immediately sells it to the customer at a markup. This markup represents the profit for the financier and is agreed upon in advance by both parties. The customer then pays the amount in installments over a set period of time. What are the key principles of Islamic finance? There are several key principles that guide Islamic finance, including the prohibition of interest, riba, financing being linked to real assets, materiality, avoiding immoral or ethically problematic businesses, and returns being linked to risks. These principles aim to create fairness, equity, and social responsibility in financial transactions. Are there Islamic loans available for students? Yes, there are Islamic loans available for students, which are designed to comply with Sharia principles. These loans can help students cover their educational costs without paying interest. Instead, the financing institution and the student share the risks and rewards in an equitable manner. How can one study and learn about Islamic finance? There are various options for studying and learning about Islamic finance. You can enroll in formal courses, certifications, or degree programs offered by renowned institutions and business schools. Additionally, you can read books, articles, or guides to Islamic finance to develop your understanding of the subject. What are the different modes of Islamic finance? Islamic finance offers various modes for conducting transactions, including Murabaha, Ijara, Musharaka, and Istisna. Each mode has its own set of rules, principles, and methods, which must be adhered to in order to comply with Sharia laws. These modes primarily focus on profit sharing, partnerships, leasing, and managed services as alternatives to conventional interest-bearing loans. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.